Today we're going to be talking about gas farming. Is it risky? What are the risks associated with me as an individual investor, or you if you're in this space? Like, what is the risk to the actual individual investor? We're going to cover so much in this video right now. I've mapped this out. I've took some notes because I want to make sure I cover everything. We're going to look at what are the risks associated with the token in and of itself? Are the average actual individual tokens sustainable? How do they work? We're also going to be looking at the Ethereum ecosystem. With upcoming changes to Ethereum, a lot of people are saying, well, how would these tokens be affected by things like EIP 1559 or 1559, however you say that, ETH 2.0? What are the changes that would be, how would those changes affect this entire ecosystem? We're going to be discussing all of that in this video. So grab a pen and paper, get ready to take some notes, buckle up, buttercup, here we go. So first things first, just understand, like, these tokens are incredible, and they offer an opportunity right now that I believe is unprecedented. Not financial advice. None of this should be financial advice, but this is, one of the things I'm going to talk about towards the end is why am I still in this ecosystem? People often say, how do you buy these tokens? Because when you first find out about them, if you're not that familiar with the Ethereum ecosystem, you might not know how to buy these tokens. First, you need to make certain that you have MetaMask installed. I have a whole video on that. I'll link that above. I'll put it in the description. You also need to buy Ethereum. You can buy Ethereum from crypto.com. You can buy it from coinbase.com, wherever. But once you buy the Ethereum, you want to send it to your MetaMask wallet. As far as buying the token, I have a video here I did yesterday where I actually demonstrated. I titled it "Made $30 in 10 Seconds," and I demonstrated what gas farming is, and I gave you details on how to actually buy the tokens. I'll link that video above so you can get caught up if you haven't seen that video, and I'll put it down in the description as well. But essentially, just to explain how this works, anytime you transact in Ethereum, there is a fee. You have to pay a fee. And when you pay that fee, they call that fee gas. And the fees on Ethereum, one of the downfalls of Ethereum is that the gas fees are quite expensive. I mean, a $10 gas fee is a pretty cheap gas fee right now. And it can easily be $30, $50, $80 or more for one single transaction. Obviously, that makes Ethereum difficult to use, particularly for smaller transactions. These gas tokens sought to solve that. And they started doing really well. Unidex Gas was the first one that I purchased, the first one that I used. With the gas tokens, the way they work is whenever you make a transaction and you're holding those tokens in your wallet. So I've got 3.6 UNDG right now. They're valued at $516 each. 2% of this value that I'm holding in my wallet, I don't stake it on the platform. They're super easy to use. Just buy them and put them in your wallet. That's it. Just for holding it in my wallet, I get $37.46 of cash back on my transactions. So if I make two transactions that are, $20 each, that's going to be $40. Well, 37 of that I will get back in UNDG tokens for the day. So it's a way to get cash. And you can take those tokens, you can keep them to increase this cashback number, or you can sell them on places like, Uniswap, etc. I demonstrate how to do that here in this video. You can sell them, or you can just stack them and get more cash back. And that seems pretty interesting. It's like, wow, this solves a major problem. That's at least how I felt at first. Like, this solves a major problem. Then I realized there was more than one token. There's an ethanol token. It works the same way, except they give 2.5% cash back. But it's essentially the same thing. So if I get $38 here and I get $37 here, if I spend $37 in gas fees in one transaction or two transactions or whatever, if I spend $37 in gas fees, I'm going to get $37 worth of Unidex gas tokens back. I'm going to get $37 in ethanol gas tokens. Now, both of these tokens charge a fee. When you claim your cash back, you pay 10%. You pay a 10% fee basically to claim that cash back. So basically, it's not 100% reimbursement. It's like a 90% reimbursement, but it's 90% from two different tokens. Are you seeing how that works? So you're making profits, literally. It's crazy. So yesterday I did a transaction last night. Ended up being, it was a cheap transaction. I want to say it was like $7, but it was crazy to come over and just look and be like, wow, I just paid $7 and I made basically $14. I mean, it's really unbelievable. And so the question is, how sustainable is this? How long can this last? So can you just make transactions and earn cash back on your gas? Yeah. Yesterday on this video right here, I basically did a 50-cent transaction. I think I paid $30 in gas fees. You would never do that under normal circumstances. But I did it just to create the gas fee so I could show you how that works. So yeah, absolutely. And so now this goes a step further. There's other gas tokens on the way. I'm part of a pre-sale that's going to be, I talked about it in this video. There's a brand new one launching. And it's going to be launching here in literally 30 minutes. So now all of a sudden you're talking about getting cash back from 3 different tokens. So I spent a $7 gas fee last night, or right here I spent a $30 gas fee. Now you're going to talk about earning $30 here, $30 on one token Unidex, $30 on a third token. Spend $30 in gas, get $90 back, pay 10% withdrawal fee, so you get $81 in profit, minus the $30 you spent in gas, so you just made $51 in profit. Yes, that is real. That is what's happening. So it sounds too good to be true. I agree. How sustainable is it? That's the first question. First of all, when someone says it sounds too good to be true, they don't understand the tokenomics. These are non-inflationary tokens, and we'll get to that in a minute, because one of the risks is bad tokenomics. So when you look at what are the risks are twofold. It's really threefold. The overall arcing risk is how Ethereum is going to deal with this problem. But make no mistake about it, this is a problem for them to somehow deal with, because it's going to cause gas prices to go up, et cetera, et cetera. And by the way, they're not going to be able to solve it with EIP 1559 or ETH 2.0. We'll get to that in a moment. It'll help, but it won't solve the problem. So here's the challenge. The single biggest challenge that you have in this space is going to be, the single biggest risk is token price. As long as this token price stays at around 500, I got in at 526. It actually went as high as 900, then it come back down. As long as these token prices stay relatively stable, this is going to be fine for God knows when. Like, it's just going to be fine. The single biggest risk is things that can cause a token price to drop. So additional products coming out, additional platforms coming out, additional clones coming out can cause the token price to drop, because people will sell, just like I sold part of this token to go into ethanol. I sold a little bit of this and a little bit of this to go into this other pre-sale, if this pre-sale even launches, but we'll get to that in a minute. So by doing that, by people selling to go into other projects, you're decreasing, there's less demand for the product. The price is going to drop a little bit. But I don't think that's the biggest risk, because at some point that stops. Like, there's a fourth and a fifth and a sixth token. At some point, you're not going to keep selling, because you need to cover your basic gas transactions. You're not going to go but so low in your holdings. So at some point that stops. So it's not going to go on indefinitely, is what I'm trying to tell you. So with that being said, I don't think that's the single biggest risk. Plus, I think a project, it could be the one I'm about to go into, it could be the next one or the next one, sooner or later, one of these projects is going to scam out. It's going to be a fake project designed to steal people's Ethereum who wanted to get in early on a pre-sale because, they were hoping for big gains. And when that happens, I think people are going to be nervous about going into future projects. And I don't know that future projects will launch, because at some point people are going to be too nervous about it. So I do think new projects can cause the token price to drop. I don't think that's the single biggest risk. The biggest risk to any one of these platforms is probably going to be a developer dumping the tokens. Its own Uniswap, they don't, it's not like it's an internal exchange, but the developers have some tokens. So if the tokens are supposed to be locked, and you can confirm that for yourself, but if they're not locked, or if the token or even a large whale has a lot of these tokens and they dump the tokens, then the price is going to drop substantially. And when that happens, keep in mind, you come in today, you buy these tokens at $500 each, you're getting 2% on your investment. But if that drops in half, now your investment, you're still getting 2% on your value, but your original investment, it dropped in half. So the value that you're holding is going to be half the dollar amount. You can still have the same amount of tokens, but for example, if this goes to $250, all of a sudden this is going to be about $15 worth of cash back. So the token price dropping could be a real problem. And if a big whale was to dump, or a developer somewhere was to dump, that could absolutely cause a problem. The third thing that can happen, and really I think this is going to be the most likely scenario, is going to be, I mean, a DEF could always dump or a big whale could always dump, but this is going to be the most likely scenario, and it's bad tokenomics. So people will say, well, how can they pay this cash back? You know, if it's a non-inflationary token, and they're not creating additional tokens. I've had a couple of comments that this isn't sustainable. You know, they're going to inflate the price, and you know, eventually, you know, the tokens are worthless, et cetera, et cetera. And it's just people who don't read the white paper. You get a lot of that in YouTube comments and in Telegram comments. People don't actually go read the white paper, and they just, you know, they give their opinion, which is fine. They're just wrong. The way the tokens work, the way they're supposed to be sustainable, I drew this little graph for you. How do you like my art? The tokens, roughly, the tokens have about 30% of their total supply in a reward pool. So there's 10,000 tokens, roughly 3,000, 3,500 is in a reward pool. And what happens is you get, this is how they give you cash back. So right here, when I get this cash back, these UNDG, they show you the USDT value, but you're actually getting it in UNDG. So if the UNDG price goes up to $600, this USDT value goes up, but UNDG stays the same because you actually get paid in the native token. So where is that 0.07 UNDG coming from? They're not printing more. It's coming from the reward pool. So how does the reward pool stay full? The theory is that you get your cash back, and then your cash back, you pull it out, you put it in your wallet. I should have done another one here. You can put the cash back here in your wallet. You can do this. And if you do this, whether it's MetaMask or whatever, you can put the cash back in your wallet. But a lot of people are going to be creating fees in the ecosystem. So when you take your cash back, remember how I told you there's a 10% fee? Well, that 10% fee goes straight to the rewards pool. The tokens go to your wallet. At some point, you may want to buy or sell the token. Now, right now, you can sell the token and there's no fees. But every time you buy the token, if you go to the previous video I did, $30 in 10 seconds, and I talk about buying the token. If you go to buy the token, you're going to pay a 4% fee. Where does that fee go? It goes over here. This box is a combination of withdrawal, 10% cash back. There may be fees on buys. There's other tokens coming out where there's going to be fees on buys. There may be fees on sales. So those fees, all of these fees go into the reward pool. The idea is that the fee structure is such that it keeps kind of a circular system. The problem is this has to be stress tested. So, you know, there's a fourth token. I'm watching their tokenomics, what they're saying. And they want to pay out 4% cash back. Straight out. Everybody gets a minimum of 4% cash back. But when they pay that 4% cash back, that means it's going to pull on the reward pool harder. They're going to give a 3% fee, and I think on the buy, and a 3% fee on the sell of the token, which I don't have a problem with that. I think it makes sense. Plus a 10% cash back fee. That's fine. But the problem is, oh no, there's no cashback fee. That's what it is. 10% buy, 10% sell, no cashback fee. But the problem with that sort of a theory, the issue that I see is so if people ultimately aren't buying and selling the token and they're just holding the token, if enough people are just holding the token for the cashback, they're not buying, they're not selling, then at some point they drain the reward pool. All of these tokens have the potential of having the reward pool drained. I think one of the reasons that I actually like UNDG so much is if you go look at their white paper, they've run some mathematical scenarios to sort of try to stress test their reward pool. Now that's just mathematical. That's theoretical. I mean, we won't know till we get into the real world. Unidex gas, I think, has the best tokenomics. I think we won't know again until the real world. But for example, ethanol. If you hold enough ethanol tokens, you get a higher cash back on ethanol. Like if you hold like I think 100 tokens, you get 3% cash back. If you hold like 200 or 300 tokens or whatever, you get higher cash back. See, but the problem with that is it causes people to hold tokens. They don't want to sell them, and those people are getting a higher cash back. See, in my mind, the way I think about that, that's going to stress that reward pool a lot more. A lot more. If a reward pool goes empty, they just can't pay cash back. It's not into the world because somebody's going to start selling tokens. And when they sell tokens, guess what? It's going to fill back up the reward pool to some degree. So it's not the end of the world. I think it's interesting that UNDG and Ethanol don't charge a fee on buys. I think they should have been charging like a 3% fee on buys, 3% fee on sales, and a 10% cash back fee. Because the buy and sell, people are like, oh, if they charge it, a 3% on buy, 3% on sale, that's a 6% fee, and then cash back, that's 16% fee. Who cares? First of all, you're still getting over 80% back on your tokens. You're still getting over 80% cash back. That's not that big of a deal to keep it sustainable. However, the people who are using the utility of the token aren't going to be the primary ones funding the reward pool. The people buying and selling at 4% or 3%, those fees are the ones going to be funding the majority of the reward pool. The reward pool has to stay full in order for these to work. Now, again, UNDG has done some interesting stress tests and mathematical calculations. Their reward pool looks like it could be the most stable. But as soon as people aren't getting tokens for their cash back, I think that's when you can see prices ultimately drop in the tokens. So, and that's going to be the interesting part is are the tokenomics good enough to be sustainable? I think there's a way to figure it out. And UNDG has already said they can adjust their 4% sell fee. Their 4% buy fee. And if that's the case, then they definitely have the ability to help keep it sustainable. Although I think that when the reward pool runs low, if you're not watching it, people are going to more likely be selling, which they don't charge a fee for that on their platform. The tokenomics is something we have to watch. And the more aggressive the tokenomics, the more you got to pump the brakes and be like, okay, how can they keep paying that for how long? And that's really what prevents me from going into further platforms, is because they're trying to compete on tokenomics. And I'm thinking I don't care how aggressive your cashback is if you can't keep paying it. So that's something to be aware of. Now we're going to be talking about Ethereum. EIP 1559, Ethereum 2.0. How can they affect these projects? By the way, if this has been helpful so far, do me a favor, smash that like button, hit that subscribe button, and click that bell notification icon, but smash that like button. Because a lot of people don't know about this yet, and I feel like more people need to be aware of these gas tokens because it's an incredible opportunity right now, especially in Ethereum. So EIP 1559, I get this. This is a proposal that the Ethereum network is working on, or at least some of the developers are proposing. I don't know how far along we are to it actually happening, but 1559, some people are under the assumption that it's designed to lower gas fees. That's not actually the primary purpose of EIP 1559. If you pull up EIP 1559 on Google, it says it is a proposal to make several tightly coupled additions to Ethereum's transaction fee mechanism, including variable size blocks and a burned base fee that rises and falls with demand. This report assesses the game theoretical strengths and weaknesses of the proposal and explores some alternative designs. So there's a belief that a lot of the miners manipulate gas fees. I don't know how accurate that is, but a lot of people believe that's why the gas fees are so high. What EIP 1559 does, it doesn't directly lower gas fees. It works to create more stability in the gas fees. So literally gas fees can adjust on every transaction. The whole focus is to create more stability in the gas fees. Now, the way that it theoretically could lower gas fees, depending on how much manipulation is happening with the miners, what they do is when you pay gas, you still pay gas. That's the important part. You still pay gas. Because as long as you pay gas, the gas tokens have utility. You still pay gas fees with EIP 1559. The gas fees get burned. The majority of the gas fees get burned. Miners don't get much. Needless to say, the miners aren't thrilled about this. We'll see if this passes, how well it works, etc. But the key feature here is it creates stability and it burns Ethereum. It makes Ethereum a deflationary token, which is awesome, especially those of us that are investing in Ethereum through gas farming. What does it actually do for the gas tokens? Well, if it lowers the fees, it could lower the price a little bit, but again, there's still gonna be gas fees. So I don't necessarily know that's it's not gonna be I don't think, my opinion, not financial advice, but I don't think that's gonna somehow kill the token. And if you do, you don't need to mess with the token, obviously. Now, Ethereum 2.0, this is the big one. So the whole goal of Ethereum 2.0, there is some theoretical overlap in the ecosystem here, because a lot of people look at EIP 1559 and Ethereum 2.0 as lowering gas fees, and they see that as the Achilles heel. So let me just say this. Ethereum 2.0 is still farther out than people realize. I mean, literally, there's 4 phases broken up into phase 0, phase 1, phase 1.5, phase 2.0. essentially there's 4 phases. By Ethereum's own admission, phase 2.0 is not happening in 2021, which means we got over a year probably, which means that's a lifetime in crypto anyway. I mean, it is a whole lifetime in crypto. Phase 2.0, it's only in the research stage. A lot of people are optimistically saying we'll see it in 2022. But Ethereum's own website has stated, or at least Ethereum Foundation has stated, that phase 2.0 is only in the research phase, meaning you can read what the goal is of phase 2.0, what they're working to do, but they don't exactly know how to do it just yet. So therefore, I mean, before the atomic bomb was created, they knew they were trying to basically split an atom, but they didn't exactly know how to do it. So that's basically what's going on with phase 2.0. They know what they want to do. They don't know how to do it. So at the earliest, we're going to see it in 2022, over a year from now, which is fine with me. At the latest, we'll see it in 2023 sometime, maybe. 2024, maybe. Hopefully we'll see it sooner than that, because I think ultimately it's good for the ecosystem. So what does that do with gas prices? What does that do with gas farming tokens? It lowers gas prices, but it doesn't get rid of them. You're still going to pay transaction fees. The whole idea, as an individual, it lowers your transaction fees. So let's just say your transactions are only $5 each, or $3 each. I don't know how low it gets them, but let's just say, would you still like to make $10 on your $3 transaction? Welcome to gas farming. It doesn't change anything as far as the tokens are concerned. Outright, nothing at all. You make more transactions, it still works. And the whole goal of Ethereum 2.0 is that, and this leads into why I'm still willing to take this risk. The whole goal of Ethereum 2.0 is to make Ethereum much more usable for the masses, allow greater adoption, meaning bringing more people in, which theoretically should raise the price of Ethereum. Well, if you bring more people in the ecosystem, that's more people who are going to be using the gas tokens potentially. That's more people that are going to want cash back on their transactions or have profitable transactions. So I don't see that doing nothing but potentially raising the price of the gas tokens in and of itself. Why am I willing to take the risk? I just told you all the potential risk. Project could scam out, devs could dump, bad tokenomics, make it unsustainable. Ethereum 1559 could lower the token price. Ethereum 2.0 possibly could lower the token price. But why am I willing to take this risk? Because I think the math just helps hedge all of your risk. If I have $1,000 here, 2% is $20, right? Yes. 2% is $20. 2% on the other token is $20. 2% on a third token is $20. That means I'm earning $60 on every $20 transaction. Roughly, I'm earning $40 back. Yes, there's a 10% fee, but let's just keep it round numbers. How many days does it take me to get my $1,000 back? Just so you know, 25 days. 25 days on one, right? So 75 days, because you got to cover all 3, if I did that right. So 75 days. Your risk is done. In 75 days, you have no risk in this project at all. And from that point forward, all the cash back, you're getting cash back. Everything you make is going to be profits. Now, that's assuming a stable token price. What if the token price cuts in half? Or what if one of the project goes bad and your returns, are cut? If your returns are cut in half, then that's fine. It's 150 days, right? Okay. And if the token price goes up, think about that. If the token price goes up, wait a minute. I just did this math all wrong. I'm talking about profits because you're getting cash back on everything that you spend, but that's fine. If the token price goes up, then you're talking about cutting that by 2. 37 days if the token price doubles. 75 days roughly, 150 days at worst, getting everything back. Okay. And by the way, this is over and above your gas fees because this is 75 days plus covering all your gas fees, which you were already paying and you didn't realize it. So you're already paying gas fees. So this is over and above your gas fees. If you include what you're getting back in gas fees as well, because that 2% that you're getting back is covering gas that you were already previously paying. See, if you do that, then it's 50 days because it's 2% a day, roughly. So it's 50 days. So you have $1,000 on one platform, $1,000 on another, $1,000 on another, or 10,000, 10,000, 10,000. It doesn't matter because it's a percentage, 2% back, if you're maximizing your gas fees. So it's 50 days in that scenario. That's accounting for the gas. But let's just say, no, we're not going to account for the gas. We'll call it 75 days. At 75 days, and you're covering all your gas fees. and you're holding an Ethereum-based token. You're in the Ethereum ecosystem. This 75 days, you're pulling out. This is assuming you're selling your profits every day back into Ethereum. So you're holding Ethereum, which has a potential any day now to just go through the roof possibly. So you're getting your ROI back much, much faster. I mean, 75 days is the worst case scenario with a stable token. 150 days if the token gets cut in half. 37 days if the token price doubles. I'm willing to take the risk on a 75-day ROI in the Ethereum ecosystem. And the true massive potential for price increase. Look, $500 on 10,000 tokens is a $5 million market capitalization on something that theoretically fixes one of the biggest problems with the entire ecosystem, gas fees. I think the potential here is enormous. There's only a few hundred. If you go look at the wallet addresses, there's only a few hundred addresses holding UNDG. Only a few hundred holding ethanol tokens. Maybe there's 1,000 holding UNDG. I don't think so though. But that's crazy. People are going to start buying these tokens at some point, I believe, not financial advice. So there's enormous potential for price appreciation. This could double. This could triple. It's already doubled. It's been as high as 900 and something. So it could triple. It could 4x, 5x. Who knows? Who knows what could actually happen? And then all bets are off. Then your earnings go up with the token price. Your 2% goes up with the token price. So the potential, price appreciation is highly possible. The residual revenue in Ethereum, I just love passive income anyway. That's what this channel is ultimately all about, being able to earn passive income streams in cryptocurrency. The fact that they are in the Ethereum ecosystem and the math just makes sense. 75 days, including covering gas transactions. So keep that in mind. A lot of people say 50 days. The 50 days is assuming that you're is counting your cash back in gas. Covers because you would have spent that money anyway in gas. By the way, if you don't know how much you spend in gas, you need to go to fees.wtf and just go look at what you spend in gas fees. Connect your wallet. There you go. So this is what I've spent on gas with this wallet. It will blow your mind. I'm going to spend a lot more on gas though because now I'm starting a gas farm. Ladies and gentlemen, today we've talked about the potential risk of the gas token for us as the individual investor. If you can think of anything else down below, let me know in the comments. I want to thank you for watching. Cryptocurrency is in an incredible, incredible space right now. I truly believe that cryptocurrency is going to change the world. So how long can these gas tokens last? I don't know. Ethereum's going to have to somehow solve this problem. And I suspect sooner or later they'll figure it out because it's not a problem yet. But at some point, someone tried to tell me in my comments, oh, no. Even this is like DeFi farming. It's not like DeFi farming. They're actually farming an Ethereum resource. Farming tokens is getting a token produced by a token creator. It doesn't clog up the ecosystem. Oh, yes, there's a lot of people farming and gas fees went up. This is different. This is you're directly incentivized for gas fees to go up. And when the right people find out about this, I think it's going to MFing explode. And at that point, maybe I'll check out and be like, all right, I'm done. Ethereum's got to fix that problem. That's their problem to fix. I'm moving on. But right now, there's an opportunity right here, unlike any other that I've seen in the ecosystem, in my personal opinion. That's why I'm here. I think the risk warrant it. If this token price, some reason, drops to nothing in the next 75 days, well, lost out on that investment. So what? But where else can I make an investment that I could ROI in 75 days and then be earning a true 2-4% or whatever? Well, actually, you'd be making on every transaction, daily transactions of $40, you're going to be making another, if three platforms launch successfully, you're making 200% profit on your transaction every single day. You spend $36, you make $36 on another platform, $36 on another platform. 200% profit on your $36 every single day. That's absolutely crazy. And I don't know what stops it particularly. I've told you the risk, but I don't know what actually stops it. I have to think that Ethereum is going to have to make a change at some point, but I don't think they're even paying attention to this. I don't think they're paying attention at all. Let me know what your thoughts are down in the comments. Thank you so much for watching. Ladies and gentlemen, decentralized cryptocurrency equals freedom. This is Crypto Wealth. I'm out.